We're looking at Brad Garlinghouse taking the stage at Davos alongside Brian Armstrong and Bill Winters, the CEO of Standard Chartered. And this discussion represents essentially the most transparent institutional cryptocurrency signal you'll encounter this entire year. This isn't social media speculation. This isn't meme token excitement. These are legitimate executives, genuine regulators, actual infrastructure, and one massive theme permeating the entire conversation. Tokenization isn't a hypothetical future concept anymore. The infrastructure is being constructed right now, and the entities that control payment systems, custody solutions, and compliance frameworks are strategically positioning themselves to dominate the next evolution of finance. And the first element I need you to recognize is the venue itself. Davos is where global narratives get established and refined. It's where governments, central banking institutions, and international banks publicly test concepts before those policies and partnerships materialize in official documentation. So when Garlinghouse, Armstrong, and Winters are collectively discussing regulation, stablecoins, tokenized assets, and settlement infrastructure on that platform, it carries significantly more weight than a random panel at a cryptocurrency conference. This is where hypothetical scenarios transform into concrete timelines. Now, here's the moment that establishes the entire tone. The moderator introduces the regulation question, and Brad essentially frames it in a manner that numerous retail investors overlook. He's not suggesting regulation is inherently negative. He's arguing that clarity surpasses chaos. And he's making this point as someone who witnessed Ripple spend years in litigation precisely because the regulatory framework wasn't clearly defined. Brad's argument is straightforward. New legislation isn't flawless on day one, but you never achieve perfection if you refuse to initiate the process. He concurs with Brian Armstrong that the United States is closer than it has ever been to achieving regulatory clarity. And he emphasizes something that should be self-evident but somehow still isn't universally understood. If cryptocurrency wants to compete with traditional banks, crypto companies should be subjected to serious regulatory standards. And if banks want to compete with cryptocurrency, banks should also be held to contemporary standards. A level playing field operates in both directions. This bidirectional accountability is crucial for legitimate market development. Quick note before we go deeper into this analysis. If you want to build genuine wealth alongside these macro shifts and institutional movements, you can accomplish that with the 100x Club, where I provide exclusive weekly stock opportunity alerts for high potential investments, plus the Millionaire Blueprint framework. So you're not guessing or speculating, you're executing with precision. It's designed for individuals who want to grow their wealth with a systematic approach, not emotional reactions. It's in the pinned comment. Back to Davos because the next segment is where the tokenization conversation becomes particularly interesting. The host references a substantial surge in tokenized assets on the XRP ledger, and Brad's response carries more significance than people initially realize. He essentially states that the true poster child for tokenization thus far has been stablecoins, and he presents the type of numbers that are impossible to disregard. He indicates that stablecoin transactions increased from approximately $19 trillion in 2024 to about $33 trillion in 2025, which he characterizes as roughly 75% growth. Whether you support Ripple or oppose Ripple, that growth narrative represents the authentic story here. Stablecoins are demonstrating product market fit at genuine scale, and everyone in traditional finance is observing closely because stablecoins represent the first tokenized instrument that's already functioning like a global settlement layer. Then Brad draws a distinction between Armstrong's Bitcoin monetary standard concept and what he considers realistic and achievable. And his argument is fundamentally that countries don't surrender monetary sovereignty easily or willingly. He even references the classic observation that governments will protect control of money supply with extreme aggression. The takeaway isn't that Bitcoin can't succeed. It's that central bank incentives are precisely what they are. And if you want adoption that's compatible with how the world actually operates, you construct bridges between traditional finance and decentralized finance instead of pretending traditional finance is going to disappear overnight. This is where Ripple's strategic positioning comes sharply into focus. Brad is effectively communicating that Ripple is concentrating on being the bridge connecting banks, payment systems, regulated entities, and on-chain settlement. That's not a speculative meme, that's a calculated strategy. And it explains precisely why Ripple discusses infrastructure, payments, custody, tokenization, and stablecoin rails so extensively, not just price appreciation. Now, the Standard Chartered portion is the segment that should make you pay extremely close attention. Bill Winters gets asked about his timeline perspective. The interviewer introduces the concept that most transactions will be tokenized by 2028 and challenges him directly. Are we genuinely only a couple years away from comprehensive tokenization across transactions, or was that projection too optimistic? Winters moderates it slightly regarding the exact year, but what he absolutely doesn't walk back is the fundamental conviction. He characterizes this moment as a major inflection point and states explicitly that stablecoins have transitioned from barely being discussed in institutional rooms to gathering genuine momentum. That observation alone reveals where institutional focus has fundamentally shifted. A year ago, it was categorized as interesting. Now it's pilot programs, regulatory sandboxes, wholesale initiatives, and the major banks are actively trying to determine how to transition that into full production. He also articulates something that matters more than any price chart or market speculation. The end state is digital settlement for most assets, including real-world assets, though not literally everything in existence. And he's stating that the direction of travel is not in doubt whatsoever. The only question is, how precisely do we get there? And his answer is regulation, regulation, regulation. He explains the practical reality. A bank like Standard Chartered operates across 60 countries, and that means 60 plus regulators with different regulatory frameworks. Even if the technology is completely ready and functional, the legal infrastructure isn't harmonized across jurisdictions. Translation: tokenization isn't blocked by inadequate code or technology, it's blocked by regulatory coordination challenges. And that's the precise reason the US regulatory standard matters so tremendously. Whether you appreciate that reality or not, when the United States establishes a regulatory standard, it influences what other jurisdictions adopt, particularly the jurisdictions conducting substantial business with US markets. Winters isn't suggesting it's easy or straightforward. He's stating it's inevitable, and the winners will be the entities who can navigate compliance across borders while still shipping actual product and maintaining innovation velocity. Now, let's transition into the piece that, in my assessment, is the biggest hidden in plain sight story in this entire transcript: the DXC partnership with Ripple and what it actually implies for distribution channels. Because if you hear partnership announcements and you're numb to them, I completely understand. Crypto is saturated with press releases that don't change anything substantive. But this one is fundamentally different because it's connected to a legacy core banking platform that already interfaces with an absurd amount of genuine banking activity. Here's the claim being discussed at length. DXC is integrating Ripple's institutional blockchain infrastructure into its Hogan core banking platform, a platform that reportedly powers approximately 300 million deposit accounts, representing over $5 trillion in deposits across roughly 40 major banking institutions. That's not a pilot program with one boutique bank. That's potentially a distribution channel directly into the bloodstream of mainstream banking operations. And the transcript even acknowledges the caveat carefully. DXC doesn't publicly disclose a comprehensive list of all banking clients, but examples mentioned include names like Wells Fargo, Barclays, US Bank, and M&T Bank, with the emphasis that the complete list isn't publicly shared for competitive reasons. Now, what does integrate Ripple actually mean in practical terms here? The way it's framed is that banks already running Hogan can enable specific modules that allow them to offer digital asset custody, tokenization services, transfers, and even programmable payments while maintaining the existing core banking structure completely in place. That last part matters enormously. Banks fundamentally hate ripping out core systems. They absolutely don't want a complete rebuild from scratch. They want add-on rails that plug seamlessly into what they already utilize and trust. And that's what last-mile connectivity genuinely means in this context: connecting bank accounts, digital wallets, and on-chain platforms without forcing banks to become crypto-native companies overnight. And strategically, this is precisely why people who only view Ripple as a speculative token completely miss the actual play here. If Ripple becomes the embedded infrastructure layer through a core banking vendor, you don't need to sell the transformative dream bank by bank, integration by integration, relationship by relationship. You sell into the installed base. You scale distribution through an enterprise channel that already possesses trust, procurement relationships, compliance frameworks, and direct access to decision makers. This also ties directly into RLUSD, Ripple's stablecoin narrative and strategic positioning. In the transcript, the script characterizes RLUSD as bank grade in the sense that it's specifically designed to fit regulated rails and institutional standards rather than being a Wild West stablecoin without oversight. And the bigger implication is if banks can issue, hold, and settle using stablecoins through a system they already run and understand, the adoption curve changes dramatically. The stablecoin becomes a feature integrated into existing services, not a cultural identity or revolutionary statement. Customers don't wake up thinking consciously, I want stablecoins in my life. They wake up wanting faster settlement times, cheaper cross border payments, better treasury operations, and programmable financial flows. Stablecoins are simply the underlying tool that enables those outcomes. Now, I want to be extremely careful here because people love to take partnership announcements and immediately scream, price explosion guaranteed, moon imminent. That's not how enterprise adoption actually works in reality. An enterprise integration can take substantial time to implement fully. Modules can be optional features that banks adopt selectively. Banks move slowly and deliberately by institutional nature. But the directional signal is what genuinely matters for long-term positioning. The narrative is fundamentally shifting from crypto replaces banks entirely to crypto infrastructure plugs into banks seamlessly. That's precisely how you achieve scale in traditional finance. And there's another line in the transcript that's specifically designed to trigger the skeptics and critics. The idea that this kind of platform underpins 6 of the top 10 US banks and processes a massive portion of daily transactions. Whether you take every single number at absolute face value or not, the fundamental thesis remains intact. If you're embedded in core banking infrastructure, you're not fighting desperately for relevance. You're already positioned in the room where relevance gets decided and implemented. This is also why the partnership ecosystem mentioned matters strategically. DXC isn't some random no-name vendor without credibility. The transcript calls out their ecosystem relationships with giants like AWS, Google Cloud, Microsoft, Oracle, Dell, Red Hat, Dynatrace, basically the exact companies that appear whenever a bank modernizes anything in their technology stack. So Ripple being integrated into a platform that sits inside that enterprise universe represents a completely different game than Ripple announces another exchange listing or minor partnership. Then the tone shifts again, and it's important because we receive a central banker perspective from the governor of the Bank of France. He's asked directly whether the euro is in danger from a Bitcoin standard scenario, and he basically expresses skepticism about that outcome. His reasoning is consistent with what Brad was implying earlier in the discussion. Money is fundamentally tied to sovereignty, and in democratic systems, the public role in money is a key governmental function. He describes money historically as a public-private partnership, but with a public anchor that provides stability. In other words, even if private innovation evolves payment mechanisms and technologies, governments still want an anchor that preserves policy control and economic stability. He also points out the regulatory concern that tokenization could multiply stablecoins in fragmented ways, and if those stablecoins aren't sufficiently safe and regulated, you introduce systemic financial risk. He references Europe's MyCA framework and welcomes US stablecoin regulation efforts in concept while emphasizing that regulation isn't the enemy of innovation, it's the guarantee of trust and stability in the system. And then he brings up a fascinating economic risk, a kind of Gresham's law style dynamic where bad currency gets used for daily transactions, while good currency like a CBDC gets hoarded for store of value purposes. The idea being that if the payment ecosystem becomes fragmented and unstable, you end up with strange incentive distortions. Whether you agree or disagree with his analysis, what matters is the central banker worldview is absolutely not crypto wins completely. Central banks lose entirely. The worldview is tokenization can happen and will happen, but we're going to regulate it extensively. This is why the Bitcoin standard debate is so complicated in the real world of politics and institutions. It's not purely about economics or technology. It's about governance, incentives, and institutional power structures. That doesn't mean Bitcoin fails as a technology or store of value. It means the path to widespread adoption depends on politics, institutions, and the fact that central banks won't voluntarily unplug themselves from the monetary system. Then we move into the Trump segment from the World Economic Forum portion of the transcript. And I want to frame this the right way for proper context. The transcript shows him stating he wants America to remain the crypto capital of the world, and he mentions signing a Genius Act and hopes to sign market structure legislation soon. The key insight isn't whether he can enumerate every token by name or explain technical details. The key is that the messaging being delivered at that level is fundamentally we want innovation, we want savings and financing opportunities, and we want to lead globally. That represents a materially different tone than we're going to crush this industry with hostile regulation. Now, the commentator in the transcript goes further and essentially argues that the industry needs leaders around Trump to explain the critical difference between speculative assets and infrastructure. The tokens and networks that actually power settlement, custody, interoperability, and tokenization versus pure speculation. And whether you agree with that framing or not, it's a completely valid point worth considering. Policymakers often discuss crypto as one monolithic blob, but the market is absolutely not one blob. There are speculative memes, and there are networks building legitimate financial rails, and there are stablecoins behaving like settlement tools, and there are tokenization platforms pushing real-world asset adoption. That difference matters tremendously because regulation tends to get written with blunt instruments, and blunt regulation can accidentally punish infrastructure builders while trying to prevent scams and fraud. So if you care about long-term institutional adoption, you should want the policymakers to understand distinct categories, not just operate on vibes and headlines. Now we're near the end of the transcript, and it drops another interesting proposition. Confidential reports identify Ripple and Binance as leading blockchain unicorns. And then we get the pick one question, the forced choice scenario. If you had to invest $10,000 in one company, Binance today or Ripple today, no splitting it half and half, no hedging your bets, which one do you pick? I'm going to give you the real decision framework here because this is where most people answer emotionally instead of structurally and strategically. Binance is fundamentally a trading empire. That's the simplest and most accurate description. It lives and dies by trading volume, market cycles, and regulatory relationships across multiple jurisdictions. When market conditions are favorable, it's unbelievably profitable and dominant. When regulators clamp down aggressively, it can get messy extremely fast. Exchanges are cash-generating machines during bull markets, but they're also the first thing governments want to control tightly because exchanges are the primary on-ramps and off-ramps between fiat and crypto. Ripple is more accurately characterized as an infrastructure and enterprise strategy. Payment rails, institutional relationships, custody solutions, stablecoin issuance, and now partnerships that potentially embed into core banking platforms. The upside is if they succeed in this strategy, they become part of fundamental financial plumbing. The downside is that plumbing takes considerable time to install, adoption is slow and methodical, and you don't always see explosive growth until the network effects reach critical mass. So your investment choice depends on what kind of risk you're actually taking and what timeline you're operating on. Binance represents market dominance plus regulatory navigation across jurisdictions. Ripple represents infrastructure adoption plus institutional distribution channels. And in the transcript, the host commits to a position. He picks Ripple and he states it's not even close in his assessment. If you're asking me to keep this aligned with the script while optimizing the analysis, the strongest argument for Ripple in this specific context is exactly what we just discussed comprehensively. If the DXC Hogan integration is genuine in the way it's framed and presented, that's a path to distribution that most cryptocurrency companies simply do not have and cannot easily replicate. It's not about being the loudest voice on social media or having the most viral marketing. It's about being installed precisely where transactions happen in the real banking world. That said, I'll state it clearly the way I always do with complete transparency. None of this is financial advice. This is about understanding narratives and strategic positioning in the market. You can be absolutely right about the future trajectory and still be wrong about the timing. And timing is everything in financial markets, especially in crypto. Let me add some additional context about why this Davos conversation matters more than typical crypto conferences or social media discussions. Davos represents where institutional capital actually makes decisions. These aren't retail investors trading on emotion. These are the people who control trillions in assets under management, who set regulatory frameworks, who decide which technologies get adopted at scale. When they signal that tokenization is at an inflection point, that's not speculation. That's actionable intelligence. The stablecoin growth numbers Brad cited deserve deeper examination. Going from 19 trillion to 33 trillion in transaction volume represents more than just percentage growth. It represents proof of concept at a scale that traditional finance cannot ignore. That volume is comparable to major payment networks. It demonstrates that blockchain-based settlement isn't theoretical anymore. It's happening right now, processing trillions in value, and doing so with characteristics that traditional rails cannot match. 24/7 settlement, programmability, transparency, and significantly reduced costs. What's particularly significant is that this growth is happening despite regulatory uncertainty in many jurisdictions. Imagine what happens when clear frameworks emerge and institutional adoption accelerates. The trajectory suggests we're still in early innings, not late stages. Bill Winters' comments about Standard Chartered operating across 60 countries with 60-plus regulators illustrate why harmonized regulation matters so much. Every bank operating internationally faces this complexity. When the US establishes clear stablecoin regulations, when Europe implements MiCA comprehensively, when major jurisdictions align on basic frameworks, it removes the single biggest barrier to institutional adoption: regulatory fragmentation. Banks can't build global products on fragmented regulatory foundations. They need consistency, clarity, and legal certainty. That's what's being negotiated right now at forums like Davos. The DXC partnership deserves even more emphasis because it represents a different adoption model than most people expect. Instead of convincing individual banks one by one to adopt blockchain technology, Ripple is potentially embedding into the vendor that those banks already trust and use for core operations. This is the enterprise software playbook: become the default module in the platform everyone already uses. It's how Microsoft dominated with Office, how Salesforce dominated CRM, how AWS dominated cloud infrastructure. If Hogan customers can simply enable blockchain modules the way they enable other features, adoption doesn't require revolutionary transformation. It requires incremental activation. That's far more realistic for how banks actually operate. They don't rebuild infrastructure from scratch. They add capabilities to existing systems. The 300 million deposit accounts and $5 trillion in deposits numbers matter because they indicate the potential addressable market for this integration. Even if only a fraction of those banks activate blockchain features initially, the volume processed through that infrastructure could be substantial. And once infrastructure is in place, adoption tends to accelerate as more use cases emerge and network effects strengthen. The RLUSD stablecoin strategy makes more sense in this context. If you're embedded in banking infrastructure, your stablecoin doesn't need to compete in the wild west of crypto exchanges. It needs to serve institutional use cases: treasury management, cross-border settlement, programmable payments. That's a completely different product profile than consumer-focused stablecoins. It's designed for different customers with different requirements. Bank grade means meeting institutional compliance standards, having proper reserves, maintaining regulatory relationships, and integrating with existing financial plumbing. The Bank of France governor's perspective reveals the central bank mindset that will shape adoption. They're not opposed to tokenization. They're insisting on regulated tokenization. They're not trying to prevent innovation. They're trying to ensure innovation doesn't create systemic risk. Whether you view this as necessary prudence or unnecessary friction depends on your perspective, but understanding their viewpoint is essential for predicting how adoption unfolds. Central banks will participate in tokenization through CBDCs. They'll regulate private stablecoins. They'll set frameworks for asset tokenization, but they're not disappearing from the monetary system voluntarily. The Gresham's law concern about bad money driving out good money in tokenized systems is sophisticated economic thinking. If poorly regulated stablecoins proliferate and people use those for transactions while hoarding safer assets, you get market distortions. This is why central bankers emphasize regulation. They're trying to prevent fragmentation and ensure quality standards. Again, whether you agree or not, understanding this perspective helps predict regulatory approaches. The Trump administration's pro-crypto messaging matters not because it guarantees specific outcomes, but because it signals a fundamentally different regulatory posture than previous years. When leadership says we want to be the crypto capital, when they discuss market structure legislation, when they engage with industry leaders publicly, it creates space for innovation and institutional participation that didn't exist under hostile regulatory environments. This doesn't mean regulation disappears. It means regulation becomes constructive rather than destructive. It means frameworks get built to enable innovation rather than prevent it. That shift matters enormously for institutional adoption because institutions need regulatory clarity to deploy capital at scale. The Binance versus Ripple comparison forces strategic thinking about different business models and risk profiles. Binance dominates crypto native trading and services. If crypto markets continue growing, if trading volume expands, if more assets tokenize and trade on chain, Binance is positioned to capture enormous value. But that model faces regulatory scrutiny precisely because it's central to crypto flows. Every jurisdiction wants to control exchanges because they represent choke points. Ripple's infrastructure model faces less regulatory pressure in some ways because it's enabling banks to do what banks already do, just more efficiently. But it faces the challenge of slower adoption because enterprise sales cycles are long and network effects take time to compound. Your choice between these models depends on your timeline, risk tolerance, and view of how crypto adoption unfolds. Do you bet on crypto native growth or traditional finance integration? Both can win, but they win differently and on different timescales. The host's choice of Ripple based on the DXC distribution channel represents a bet on infrastructure over speculation. So, to wrap it up the way the transcript does with proper synthesis, you've got major institutional figures explicitly stating that tokenization is at an inflection point. You've got stablecoins demonstrating product market fit and acting like the first real scaled tokenized product. You've got central bankers basically communicating will allow innovation but with comprehensive regulation. And you've got a potentially massive enterprise integration story with DXC that could give Ripple a distribution rail into mainstream banking without needing to win every single deal one at a time through individual sales. If you want more content like this conversation is substantial enough that it could absolutely be turned into a multi-part breakdown where we go clip by clip and map each claim to what it means for positioning in 2026 and beyond. If that's something you want to see, you already know the process. Let me know in the comments, and the engagement tells me it's worth producing. And finally, if you extracted value from this analysis, like the video, share it with people who need to understand these institutional signals. And if you want a real systematic framework for building wealth beyond headlines and hype, check out the 100X Club. You get exclusive weekly stock alerts for high potential opportunities, the Millionaire Blueprint Framework, and a simple system designed to help you identify 100X style setups and grow your wealth without guessing or gambling. It's in the pinned comment below. Thanks for watching, and I'll see you in the next breakdown.